This is VeriScope News. Verified news, clear context. We report on institutional data and official releases. We explain what the numbers show. We explain how those numbers fit into longer-term trends. We do not speculate. We do not frame events emotionally. We do not offer opinions or advice. Each report is built from primary sources. We rely on government data and established institutions. We present information in a calm, professional manner. Today's report focuses on the U.S. labor market, specifically weekly unemployment insurance claims. These figures are among the most frequently monitored labor indicators. They provide early insight into layoffs and job separations. They are released weekly by the U.S. Department of Labor. Because of their frequency, claims data often shapes near-term labor expectations. They are reviewed by economists, policymakers, and financial analysts. This report draws exclusively from official data reported by Reuters. All figures reflect seasonally adjusted government releases. Weekly jobless claims measure how many people file new applications for unemployment benefits. These filings usually occur shortly after job loss. This timing makes claims data highly responsive. It reacts faster than monthly employment reports. It often signals labor market shifts earlier than payroll surveys. However, weekly data is also volatile. Short-term fluctuations are common. Calendar effects influence filing behavior. Holiday schedules disrupt work weeks. Weather events delay filings. Administrative processing can shift timing. To account for these effects, claims data is seasonally adjusted. Seasonal adjustment smooths predictable patterns. It allows for comparison across weeks and years. Even with adjustment, economists avoid overreacting to one report. They evaluate trends over multiple weeks. They compare current levels with historical norms. In recent years, the labor market has changed. Job openings declined from post-pandemic highs. Hiring slowed. At the same time, layoffs remained limited. Employers reduced aggressive hiring. They also avoided large-scale job cuts. This environment is often described as low hiring and low firing. Weekly claims data helps confirm whether this balance continues. For the week ending January 17th, initial jobless claims increased modestly. They rose by 1,000 filings. The seasonally adjusted total reached 200,000. Economists surveyed by Reuters expected 210,000 claims. The reported figure came in below that forecast. This indicates fewer new layoffs than anticipated. Layoff activity remained restrained during the period. The report was released by the Department of Labor on January 22nd. It reflects claims filed through state unemployment insurance programs. The report also includes continuing claims. Continuing claims measure how many people remain on benefits after the first week. For the week ending January 10th, continuing claims declined. They fell by 26,000. The seasonally adjusted total reached 1.849 million. Continuing claims are often used as a proxy for hiring conditions. If people find jobs quickly, continuing claims decline. If job searches take longer, continuing claims rise. The decline suggests some movement off benefit rolls. The reporting period overlaps with the payroll survey window. This timing links weekly claims data with monthly employment reports. Seasonal adjustment becomes more challenging around year-end. Holiday closures alter filing schedules. Temporary layoffs increase in some industries. As a result, weekly claims can appear noisy in December and January. Short-term swings may not reflect true labor conditions. For this reason, economists emphasize ranges rather than single points. Historically, claims below 300,000 signal a stable labor market. Claims near 200,000 are considered low by long-term standards. Over the past decade, average claims were higher than current readings. This places the latest figures well below historical averages. Payroll data provides additional context. Non-farm payrolls increased by 50,000 jobs in December. That figure aligned with the monthly average for 2025. It reflected slower growth compared with earlier years. Payroll estimates are subject to revision. The Bureau of Labor Statistics conducts annual benchmark revisions. These revisions reconcile survey estimates with administrative records. The upcoming revision is expected to show weaker job creation. The BLS estimates 911,000 fewer jobs were created in the year through March 2025 than previously reported. This adjustment reflects measurement challenges. One contributing factor is the birth-death model. The birth-death model estimates job gains and losses from business openings and closures. It relies on assumptions when real-time data is limited. Starting with the January report, the BLS will revise this model. Current sample information will be incorporated monthly. The goal is improved accuracy over time. Households. Stable jobless claims suggest fewer abrupt job losses. This supports income stability for many households. Workers who remain employed face lower immediate risk of separation. However, job mobility has declined. Fewer openings limit opportunities to change jobs. This can slow wage progression for some workers. Households may respond by reducing discretionary spending. They may also delay major financial decisions. Prices. Labor conditions influence inflation dynamics. Limited layoffs reduce downward wage pressure. At the same time, slower hiring restrains rapid wage growth. This contributes to more moderate labor cost increases. Moderate labor cost growth affects pricing decisions. Businesses may face less pressure to raise prices. Jobs and labor. The labor market remains balanced but cautious. Employers appear selective. Firms invest in automation and artificial intelligence. These investments reduce reliance on new hires. At the same time, existing workers are retained. Large layoffs remain uncommon. This pattern supports stability but limits expansion. Savings and investment. Employment stability supports household cash flow. However, slower income growth may limit savings accumulation. Households may prioritize liquidity. Long-term investment decisions may be deferred. Businesses. Businesses face uncertainty about future demand. They manage labor costs carefully. Weekly claims data suggest firms are holding payrolls steady. They are neither expanding rapidly nor contracting sharply. Economists will monitor upcoming labor releases. The January employment report is a key focus. Payroll growth will be evaluated. Unemployment rates will be reviewed. Labor force participation trends matter. Wage growth remains under observation. Revisions to prior payroll data will receive attention. Weekly claims will continue to be tracked. Sustained increases would signal rising layoffs. Sustained declines would suggest stronger labor absorption. The latest data indicates stability rather than acceleration. Layoffs remain limited. Hiring remains cautious. The labor market continues to adjust gradually. Short-term volatility should be viewed in context. Weekly claims are one data point. They are best interpreted alongside monthly reports. Seasonal adjustment relies on historical patterns. It smooths predictable fluctuations. However, unusual periods challenge these methods. Holiday timing varies year to year. Benchmark revisions correct accumulated discrepancies. They align survey data with administrative records. These processes improve long-term reliability. They also explain why short-term readings can fluctuate. Understanding these mechanics helps interpret weekly changes. It reduces the risk of overreaction to individual reports. This has been VeriScope News. Verified news, clear context. We will continue monitoring labor market indicators. Our focus remains on official data and institutional reporting. Thank you for watching.